Good evening. This is the March 2026 end of month update on how do we invest in the current stage of the Indian markets with a lot of things going around us. So I'm going to cover a few topics here. Some of them I covered in the last session of the Feb end of month as well. But in terms of the session for this month end, we take a look at top three things that are most important for every session that we do is where are the Nifty valuations right now? How does the system liquidity look like? And what are the interest rate trajectories uh, most likely going to signal out? I want to talk about equity risk premium uh, to indicate whether it makes sense to invest in equities or hold in bonds at this point. Looking at just the yields on each of the sectors, we look at the market breadth, and I will also talk about where I'm parking my funds currently until the indices or the equity markets at least come to a fair valuation or stabilize a little bit at certain price points. I would prefer a fair valuation or a lower than fair valuation than stability in the price, right? Volatility is acceptable, but at least the the price has to come down to a fair valuation. If we look at the Nifty valuation, this is where somewhere we are here at this point, which is just below the median value. That's a very good sign. Uh, the real investment area only lies here, right below this line at 16.15 uh, multiples of Nifty P. For that to be achieved, I think I've already given out the value. The value is around 17,140 or 17,100 if you consider a round number. This is where uh, there would be, in my opinion, again, it's a personal opinion, it's a significant uh, value. Now, here as well, if you are having a valuation of Nifty of around 16.15, and then you go and invest in a stock that is already at 200p and 100p, I think the story is very clear that at such high valuations, even though you have invested in a very good level of Nifty, those will not give you an alpha. They'll give you a return, but they'll not give you an alpha. When I say alpha, we have to beat Nifty. If we can't beat Nifty, then you better just invest into a Nifty ETF. So in terms of valuation, I'm expecting more downside, right? If it wants to go into a attractive zone to invest into, which is only at this point, or if it drops lower, much better. If you look at the system liquidity, again, there is no update from the previous one. The system liquidity does look expansionary. The central bank is expanding its balance sheet, which is a sign that they're not curtailing back on liquidity. But there are very high chances that the system liquidity could be curved back. We could see a sharp pull in system liquidity because with everything that's going around, the crude oil prices, the unlikely rainfall that is happening across India right now, which is going to simply destroy the harvest that was about to come, which is eventually going to, you know, add into the food inflation. So, two important aspects, which is food and fuel prices, are both going to rise up. When inflation rises, the central bank will be forced to do two things. One, either either increase the interest rates or reduce the liquidity in the system in order to make funds less available. The same story is on interest rates. Now, if the liquidity is not curbed in the real uh, next few months, then the vote for me is going to be to raise the interest rates, right? uh, because from here we will see a trajectory of interest rates going back all the way up to 5.5, 5.75 of that range, because the need to curb inflation will become very important in that case. But it's a wait and watch situation right now, but at least broadly, the food inflation is likely to rise and the fuel inflation is also likely to rise. In terms of geopolitics, we're already seeing what's happening, but there are wars going on related to capturing natural resources, which will impact India's crude oil supply and thus lead to inflation further. There is a very interesting take that if the US manages to control the majority oil reserves, except of that of Russia, it can along with its allies, control the oil prices at its will to put any economy into the slowdown, right? And I think Iran is rightly fighting for themselves and also rightly fighting for the fact to not give out all the control of the oil reserves because they are one of the largest producers of oil, along with Russia and along with the UAE and along with US also themselves being a large producer of oil. So it will be interesting to see how it plays out. But the goal is that we do not see uh, any reduction in the crude oil prices, at least in the near future. It's going to be very difficult to tame the crude oil prices with whatever is going on. And if it does not settle and US takes a full control of Iran, which is very likely looking at what is going on, very unlikely at looking at what is going on, then we will see some stabilization in the crude oil prices later in the year if this all stops. Most important is the equity risk premium, right? The Nifty P, I'm considering at 20, it's around 19.9 or something. The government bond yield, this is an old number, 6.48, but right now the bond yields have just shot up to 7.1%. And the earnings yield on a Nifty is close to 5% or maybe around 5.1%. So if you keep your that's what it is saying at this point is if someone holds their money into a bond right now, they will yield close to 7.1% of their investment. And if the same is held in an instrument like a Nifty ETF, they are likely to get an yield of 5 to 5.5%, depending on how the valuations correct from here. This is all basis a Nifty EPS of uh, the current EPF of about 1,143 across the 50 companies that we have. So it does clearly indicate that the bonds are competitive. Um, is that the case? Is that going to be the case for the entire year? Nobody knows. We do not know where Nifty is going to turn out by the end of the year. If it turns out much lower in valuation, then this spread, the ARP spread that you see can be very, very low or even positive, which will make equities extremely attractive to invest for a very good long-term time from here. This is something that I personally track, uh, which is market breadth. Now, any stocks above 200 DMA is a good sign in terms of the continuation of bullishness of those stocks. What we are seeing is as of the March end of month, if we look at the 524 top Indian stocks, uh, and the 524 number comes from any stock which has a market capitalization of 10,000 crores or more, we will see that for the 73% of the stocks out of that 524 Indian stocks, they're all trading below 200 DMA. From a breadth standpoint, it is not a very good sign for a long-term bullish market. You would want the majority of your stocks to trade above the 200 DMA. That's just a sign that there is just no strength left, and there will be continuation of the sell-off, which is also aligning with what we've seen on the other screen, where the valuations are just below the median. They're still not in the attractive zone. So there will have to be exchanges of wealth. There will have to be the losers will have to give up their positions. They will be forced to give up their positions, and a new cycle of investment will begin once it goes to a level where it is way more attractive than where it is currently. Then you will also see the stocks to slowly revive about the 200 DMA, and that breadth will again go on the other side, where 50% of more of your stocks in the market are above the 200 DMA. So the market breadth definitely is not great at this point. Now, with all this happening, where am I parking my funds? It's very clear that with bonds being competitive, with everything going on around the global markets, equities being at higher valuations, it makes more sense for me personally to hold all the funds to invest, or the new funds that come in at this point, into a government security backed fund. You can search for any gilt fund. Uh, no particular AMC is going to be different, because everyone invests almost 95 to 96% of their holdings into a government bond. There are other funds such as liquid funds, but that is not preferred at this point, because liquid funds will hold a lot of their money into the certificate of deposits, commercial papers, and less into government backed securities. The reason I'm preferring a government backed security at this point is because anything can happen, right? And the worst thing is that uh, the banks taking a hit in terms of their liquidity management. So, and it's, I'm not saying that could happen. The liquidity in the system is very good, but if the tightening happens, then it could lead for some banks who have not planned their asset liability management well, can be in a lot of trouble. So that's why I don't want any exposures to any of the banks or their holdings, because the moment the banks will crumble, the mutual funds will stop redemption from those funds. So that's why the belief is more towards government securities. Uh, and I think that would really give us a good cushion to move forward. That's all for this month. If you have any questions, leave them out in the comments. I'll try and answer as much as possible. All of these things that I'm saying, this is my own study, this is my own journaling of how I'm thinking about investing and thinking about the future in terms of investing and where my fund should be held. I would recommend each one of you to also consult your financial advisor before clicking the buttons and hitting investing uh, on your personal level. Thank you so much for watching. Bye bye.